All right, welcome everybody. We're gonna get going because it's noon. We might have more people join us, but just to let you know, I have you guys on mute, but you can unmute yourself if you have a question. So when I get to the question part, if you do have one, just unmute yourself, and that way I don't have to unmute everybody. Figured that one out last time. Okay, so today we are talking about the CARES Act, and if you've been keeping up with the news, you know it's a big deal. It got passed on Friday when we were doing our last webinar, which was very exciting, and it was signed into law the same day. We reviewed the CARES Act a little bit on that last webinar, and what we're going to do now is we're going to look at it in depth over the next 2 hours. We're going to touch on the major changes and really look at all the relief available so that people can understand their options and then make a decision if they want to do some borrowing from the SBA. So let's get started. My name is Tiffany Donaldson. I'm a business attorney in Brooklyn, New York. I've practiced for over 10 years, and this is what I do. I do employment law, helping business owners make these decisions that are coming up about who to keep, who to let go, how to move forward in this environment, what are the new leave laws and provisions we have to follow, and what can we do. So if you have any questions like that, you want to have an individual consultation, feel free to email me after the presentation. That's me. Okay, so the CARES Act. The CARES Act is major legislation recently passed to help everybody who's mostly a business, whether small business or large business. But this webinar focuses on these four major parts, or these three major parts of the CARES Act, and we're going to touch a little bit on some other New York City available relief to make you aware of it. There are other parts of the CARES Act. There are parts that go more in detail about tax saving opportunities, ways to borrow from your 401k without being penalized. We're going to touch on those, but this, just so you know, is more about these three major changes for relief. So I just want to let you know that this is a comprehensive act. This is only part of it. And so if you hear about these other things, they do exist. I don't want to, make you think otherwise. Okay. So we talked about the act, CARES, Coronavirus Aid, Relief, Economic Security. So we'll always have coronavirus as one of our laws. And so what is it? Okay. So this is a major point of this webinar. This act modified the SBA 7A loan program. And what it did is it loosened all the restrictions that really kept, people from getting a 7A loan unless they met all these specific provisions. And we're going to go over a lot of the changes, but generally that's what it did. In this portion. So this portion we're talking about is the Paycheck Protection Program. That's what they've called it. If you hear somebody say that, that just means the changes to the SBA 7A loan program. So there you go. Okay, so who's eligible for this? I should have put a party hat here because this is really available for almost any business in existence before February 15th, 2020. So it's any business, any nonprofit, veterans organization, or tribal business that has 500 employees or less. Remember, we're talking about the smaller businesses here. And just in case you were wondering, it is available for people operating as a sole proprietorship, or you call yourself independent contractor. You're self-employed, so you're employed by your own LLC, let's say. Everybody is eligible. One of the major changes, and what makes this so exciting, is that you do not have to prove losses, which has been a major kind of conundrum for businesses seeking other types of funding under these programs because they might be down 10% but not 25%. So You don't have to prove any losses. You just have to affirm at some point that you're generally affected by COVID, but it actually assumes that all of our businesses were affected. So it's basically just assumed, which is a really big hurdle to get over. Okay, so the other major thing that we're going to review today is called the Employee Retention Credit. This was also created by the CARES Act, and we're going to talk about it more. But one of the major things that we have to consider is that you're only going to be able to either get your loan under 7A or take this retention credit. And so they're setting it up for you to have to evaluate which one of these is going to be better for you. So everything we're learning about today is the rules. And then we're all going to have to go back and calculate which one's better for us if we want to take advantage of any of these, which you're not required to, but I highly encourage you to. So that's the main point here. Okay, what are the loan terms? So we're going to talk about the repayment portion, and that's another party hat. There's a large portion of your loan that you're not going to have to pay back, and that's really a loan turning into a grant, which is amazing. But if there will be a portion of the loan likely left that isn't, fully paid by the government. And so these are the loan terms. There's a maximum 4% interest rate. It's likely going to be 4%. I'm not quite sure how you could get under it. Maybe you have stellar credit. And a maximum 10-year maturity date. Why is this important? Because we're going to compare this to the emergency disaster relief loan. And it's going to have a lower interest rate and a longer maturity date. So it's going to be another thing to consider when you're playing all the factors to figure out what you want to apply for. All right, so this is the other major question. What can you borrow under this new 7A program? They're going to allow you to borrow 2.5 times the average total monthly payments that your business generally had over the last year, basically of payroll costs. And this is further defined, so don't jump the gun. That's the next slide. There's a maximum borrowing of 10 mil. If you need it and you can get up to 10 mil, you can get up that high, but you can't go over. All right, so what is a payroll cost? So remember, you can borrow 2.5 times the average total monthly payments that your business makes for payroll costs. So it's very important of what's in and out of a payroll cost. And this is a legal definition. All right, so this is the major slide. Stay with me here. We've got salary to your employees. And if you're employed yourself by the business or you're an LLC and you're an owner, generally this is also going to count as your payment too. So don't think, oh, I'm an owner, I don't count. Nope, you count. So we got salary, wages, commissions, or similar compensation. All right, caveat. It's not a law without a caveat. When it comes to individual employees who are paid $100,000, over $100,000 a year, they're just going to count your annual salary as 100 and then prorate it by the month, meaning divided by 12. And that's the max compensation you can get. So if somebody makes 150 for calculating your average monthly cost, you're going to back them down to 100. Okay, so keep that in mind. So that's one caveat. But I lost it. Okay. Payment of cash tips or equivalent. What does this mean? This means if you have, yeah, okay. Somebody asked the question, independent contractors. Yeah, we're getting to that one. If you have cash tips that your employees get from working, that's included in payroll costs because it's something they're missing now. Payment for vacation. All right, so this, when we talk about, this is major because if you pay out vacation, you pay out sick leave or family or medical leave regularly, this can really bump up what's your monthly payroll cost calculation. So note, major note for whoever was on the last webinar, Family First Coronavirus Response Act leave, everything we went over on Friday, cannot count as part of your payroll cost calculation, because why not? Because we know you're getting dollar for dollar reimbursement for that already. So they're not letting you double dip on that one. Okay, so somebody asked about independent contractors. Yes, that's the next slide. So keep in mind, this is the same slide. I just couldn't fit it all on one. So we're still going about what is your payroll cost. Okay, look at this. Allowance for dismissal or separation. That was included in something you paid somebody out when they parted ways from your company. Payments for provisions of group healthcare benefits, including insurance premiums. This is something the employer paid. Payment of retirement benefit. And even the state and local taxes on the compensation of the employees that the employer paid are counted. Note what's missing here, federal. You're not counting that. Okay. All right, so we have the question about what about payments to independent contractors? Yes, those are included. So that's what's in this paragraph. The sum of payments of any compensation to or income of a sole proprietor or independent contractor. So what does that mean? Payment to. So compensation to an independent contractor is going to be included. So if you run your business with 10 contractors and no employees, your payroll costs are the costs that you're paying your contractors, and they're acknowledging that. And the same thing with the self-employment. If you make 150, then you're going to be capped at 100 for your salary. So that's all this part is saying. In a major exclusion, what do they exclude? They exclude compensation of an employee whose principal place of residence is outside of the U.S. Interesting. I don't know why that one's specifically in there. Maybe because they're not regularly paying U.S. taxes. So really the caveats we went over are that Family First Coronavirus Response Act League doesn't count. Compensation over 100,000 is counted as 100,000 and divided by 12 basically. Otherwise, this is what the government is defining as the payroll costs. So if you have a question, is this in, is that out? This is the list. So you got to check it within this list and then, yeah, so we had a question is 100,000, let's say I individually make 100,000, I'm the owner of the business, and I also pay independent contractors. Do we get to add, the 100,000 plus the amount paid to contractors? Yes. The payroll is basically everyone on your payroll, meaning everybody that was getting paid off of your company, which includes you and your independent contractors and your employees. So they're acknowledging all three. I'm going with the questions here. So hold on, we got some questions going on in chat. So give me 1 second. How does an independent contractor determine their compensation if it's intermittent, like a realtor? Yeah, we're going to go over right now how you determine that monthly amount. So it's not up in the air, it's very specific. So that's the answer to this question. All right, so how do you calculate an average month? The law is specifically making us do it this way. All right, so what are they going to do? It's going to look at the 12-month period prior to the date the loan is made. So what does that mean? The 12 months is going to be different for all of us depending on when we take out this loan. So if I get the loan on June 15th, then it's going to be from, June 16th of the previous year through June 15th. And that's going to be the 12 months they're looking at. And then we're going to take the average. So this number is going to kind of, go back and forth between a couple months depending on what's the actual date that you take out your loan. They have a caveat, but this, as they say, only applies for businesses who were not in business from February 15th through June 30th, 2019. So basically, your business doesn't go back 1 year, then you don't have a whole year to look at. They will let you use the average payroll from January 1 through February 29, 2020, which is only 2 months. So you take 2 months payroll divided by 2. This caveat is only for businesses that started after February 15th, 2019. So you have to decide, when did your business start? If your business has been around a while, just take your last 12 months. If it hasn't, then you're going to be able to use this short formula. You don't get to pick the formula because some people could be benefited by using the second one. Unfortunately, you don't get to choose. As of now, you have to take it as it comes. Okay, I'm just going to check some of our questions real quick. We have a question, a really good question come up about founders who weren't paid. Can they participate? Let me follow up with that question about unpaid founders. That's a really interesting question because they won't be showing up on the books, but I have a feeling they may not be able to, but there's a lot of relief out here. So if this one isn't for you, let's go through all of them and then we'll figure out the one that is for you. Do the taxes and health premiums get added on top of the 100K salary? Yes, as far as I know, they do. That's a really good question. I believe they do. They don't say anything about the cap including anything besides the salary. I think they just didn't want to award high earners. But when it comes to the health premiums and the taxes, as far as I know, those are on top. But that's a very good question, so let me follow up with that one too. Okay, so now we have our average month. I just wanted to do a couple examples, and then I'll, honestly, if you have a question, if you chat it to me, it's actually easier for me to share it with the group than open it up. So why don't you just chat me a question if you have a question as we go along. That way it'll be relevant to the topic that we're on. Okay, so calculating your average month. I just wanted to make it concrete for you guys. Might seem straightforward, but just in case you are looking back at this. All right, so if you've been in business since January 1, 2019, like we said, you're before that cutoff date and your loan date was June 15th, then you're going to look at your payroll costs from June 15th, 2019 to June 15th, 2020, divide by 12. So that's the regular. If you were a new business, let's say just went into business last year, March 15th, then you get to use your payroll costs from January 1 to February 29th, divide by 2. So just so you can remember. Okay. We're going to go over 2 other major programs. So just keep in mind we're learning right now. Then we can compare and discuss them after we go over the basics. Okay. The Paycheck Protection Program, uses of the funds. So the funds that you're getting, remember, 2.5 times that salary total. Basically, these are meant to be used on expenses incurred from February 15th, 2020 through June 30, 2020. Why? That's the period that we're down, right? That's kind of like the accepted closure period. Doesn't bode well for opening in May, let's put it that way. But they're acknowledging it could at least go through June 30. So to the extent you've already utilized, obviously, your own funds to pay for some of these, then, you obviously get reimbursed. But this is, what they intend the money to be used on. So payroll, expenses, employee salaries, costs related to the continuation of group healthcare benefits. So as you can see, this money's meant to help you stay in business, not just lie in your pocket. So interest on a mortgage application, rent, including under a lease, utilities, and interest on any other debt obligation incurred before the covered period. So this is meant to be money you know, think about 2.5 times, 2 months and a half, to replace what you might have been missing, to try to keep you afloat and to keep your employees in place. In all honesty, they're trying to encourage you to do that. But as we'll discuss, you have to do what's right for your company. So those are the uses. Okay, now this is the party hat portion. Get out your party hat. We're talking about free money. Forgiveness of a loan is money you don't have to pay back. You're not penalized for it under this program. And so it's basically the equivalent of a grant, meaning, you know, you don't have to pay it back. So they're willing to forgive 8 weeks of your use under what we're going to discuss. And this is how you're going to determine how much. So we looked at how much you can borrow. Remember, that's different than how much can be forgiven. It's a whole other calculation. And there are some reductions to this calculation that we're going to go over in the next slide. So this is the base, and then we're going to say it might go down depending on your actions. So stay with me here. All right, so let's say you get your loan, the 8-week period, right? Those 2 months following the date you get your loan, you're paying your normal business stuff, right? You're in business, you're doing business. So money used during that 8-week period is what can be forgiven when you use it as follows. On payroll costs. So what does that mean? Everything you use on payroll costs during the 8-week period, you don't have to pay back. Payment of interest on a mortgage liability, where that was in place prior to February 15th. So basically, they are not going to let you get into something new and reward you. It's just about things that were already in place. There's weird decisions they had to make here. Not all of it makes 100% sense to me, but we're just going over how they wrote it. Okay, rent that you already had under a lease that was enforced before February 15th. And payment for a service of gas, electric, water, telephone, or internet that was already in place before February 15th. If you made a major move in March or April, it's going to be hard to qualify for some of these things because they won't have necessarily have been in place. There'll be new contracts. So ultimately, their goal is to kind of encourage you, incentivize you to not make major changes, to keep everything going, to incentivize you to get to your 8-week free money period. So isn't that interesting? That's where they went with this. Okay, so we're going to go over some calculations, but this, so that is what we just went over, the maximum amount you can get forgiven. What you can get forgiven is going to go down based on these next 2 reductions we're going to go over. So why is that? It's incentives, right? They want you to want the free money. So if you want free money, they're going to hope that you don't do something to reduce the free money. So we're talking about pure incentives. All right, so you see my scissors here because we're talking about losing employees. So the first type of reduction under the CARES Act is looking at how many people are still employed. So you're going to take the average number of full-time equivalent employees during the 8-week period, right? So let's say you got your loan June 30th. We're talking about who's employed after you get this loan for 8 weeks, divided by the average number of full-time equivalent employees you had early in the year, from January 1 to February 29th. So what are they looking for? If you had 10 employees earlier and now you're down to 5, you're only going to get half of your total forgiveness eligibility amount. So what does that mean? They're trying to encourage you to keep your employees in place. So there's another option of the bottom here is the average number of full-time equivalent employees from February 15 2019 to June 30, 2019. Why do they have these two options? It's possible that your average number of employees in like the winter time is maybe not the same as in the summer of last year or during the spring of last year. So they're kind of giving you the option to try to figure out your best calculation. But those are the two time frames. So you can either pick this time frame or this time frame as your average, and it's the equivalent employees during the 8-week period as the number at the top. So I did an example to make this a little more concrete. It's a little confusing, but if you look through the example, it makes sense. So if your loan date was June 1, and you were gonna be eligible for $100,000 in forgiveness, and your 8-week period has to start June 1, because that's your loan date. So it's gonna be all of June and all of July. So that's gonna be your 8-week period. Let's say during that 8-week period, you had 5 employees. Well, if in January of this year to February 29th of this year, you had 13 employees. And last year from February 15th, 2019 to June 30th, 2019, you had the average of 10 employees. You want to be able to take all this information and make your best possible eligibility amount. So we're going to say the eligibility amount's 100,000, and we're going to multiply it by 5, which is how many employees you have left, where the 5's been divided by the denominator. That's going to give you the best outcome. So you'd rather have 5/10 of your money than 5/13 of it. So we use 10, we use the number of employees from February 15th to June 30th of 2019 as the denominator. So you can see how you can pick the denominator that's going to give you the best outcome. Okay, hope that wasn't too much math. Now, there's a second type of reduction, and it's not either or, it's in addition to that employee retention calculation. And this has to do with salaries. So you're thinking, well, if people are going to keep employees, why don't they just cut their salaries, keep the employees, and make it to get the money? So they kind of considered that people might think about that, and so they put in a caveat about keeping employees and reducing their salary. So you're going to get a reduction from your free money if in the amount of this calculation. So it's the amount in total salary, the reduction in total salary incurred by employees over the 8-week period. But it only applies to reductions to an employee who was already making under 100,000. So if you had somebody at 150 and you knocked them down to 100 during this time, they don't count in this calculation at all. So you got to know who it applies to. So we're talking about everybody who made 100,000 or less. And then we're looking at the salary decrease where it's over 25% of what they were previously making. So what does that mean? If you had an employee that was making 99,000 and you knocked them down to 95,000, their salary did not decrease over 25%. And therefore they wouldn't even be included in this. So the only reductions that are going to end up in penalizing you is a major reduction where the employee's salary was reduced at least 25% over what it was previously. So just did a similar example. Same loan date, June 1st, 2020. Same forgiveness eligibility, 100,000. 8-week period, same. Average employees during the 8 weeks, same, 5. Okay, let's say of those 5, 3 people stayed the same. 2 people went from making 90,000 to 60,000. So first of all, are these 2 people making under 100,000? Yes, so they count. So we have to start there. Then, how much was their salary decreased? Okay, we can see with quick math that it went down 33.3%. That's over the 25%. Okay, so what do we do now? Calculate the 25% decrease from 90,000. That would be 67,500. So then you want to subtract what they're actually down to from 25% down. So we had 25% down would be 67.5. but they're really 33% down. They're at 60. And what you have left is 7,500. That amount that's under the 25% reduction is what is going to end up being reduced from your ability to get free money. And here it's times 2 because we have 2 employees. So it's per employee how much they were down. So they were down 7,500 below a 25% decrease. That's a $15,000 total reduction. So if you take the 100,000 minus the 15,000, that would be an $85,000 forgiveness eligibility. Okay, so I'm going to take a couple questions real quick. Let me see here. Okay, how's the average employees calculated? We're going to go over that in a minute in another slide. And availability for rehire, we'll go over that. What if one position was filled by a new person? That's okay. When we get to the rehire part, you'll see it's not about the individual, it's about the working position. If you take draws but you're not on your company's payroll, are you available for payroll protection? Yes, that's what I mean in you're an owner. If you're an owner that gets paid out of your business through draws, you're going to be eligible for paycheck protection. They didn't forget about you. Combining the examples. Yeah, so that's my next slide. Okay, so somebody asked about the combination, and this is my point that I wanted to get to. So in our combined example, where we have the loan forgiveness, we have the average employees being 5, we have the loss in salary. The total reduction is going to be reduction number 1, $50,000 due to the decrease in employees that we reviewed. And then reduction number 2, $15,000 due to the decrease in salaries. So that total eligibility of 100,000 goes all the way down to 35,000 when we put both reductions on there. So somebody had asked that question, so yes, you're correct. So this understanding how the reductions work, and that reduction process just spins more questions out. So I'm going to answer some of the questions here. They're actually going to come out with more guidance. Everybody's going to have similar same questions. And this law just passed, hot potato. The reason the guidance isn't out yet is because they didn't have time to make it yet. That's how new this is. But everybody's highly interested in it, and they're under the gun to get out guidance. So there's going to be more specific answers to a lot of these questions coming straight from the government. But right now we're going off the answers that we can glean from the current law. So let's talk about the rehiring provision. All right, so number 1 question, once you hear about this reduction, is can I rehire if I could afford it to avoid reductions in this money? Okay, one of the things they are doing is they're trying to encourage everybody to not, and at least in my opinion, they seem to be trying to not encourage people to lay too many people off, to try to keep as many people around as you can. And you're seeing the incentives of like, we will literally just give you the money, just keep them. Okay. So what happens? This is so interesting. I don't know how they came up with this process, but pay attention to exactly what this says. This is an important slide. So they say if you reduce the number of employees or salaries, like we discussed, from between February 15th and April 26th, which is, what is this, like a certain number of days after the passage of the law, I think 30 days after this law passed. All right, so during this period, February 15th through April 26th, if you do a reduction during that period, you're not subject to the basically the reduction provision. You're not subject to penalty if everything that you laid off or deducted is returned, rehired by June 30th of 2020. So if by June 30, 2020, you brought the same amount of number of people back, or you re-raise the salaries back up by June 30, 2020, they're still going to let you get your money. Where is this coming from? To me, I think it's an acknowledgement that it takes time to rehire, that you might not be able to keep somebody up to April 26th, but post April 26th, maybe you will have the ability to bring them back if, you know, maybe business picks up or something. It's a very interestingly worded. So if you have a question about bringing them back to get your money, this is their answer. I'm sure there will be more guidance on this, but it's very interesting to me. So what does that mean? The way that I read this, in all technicality, you're not going to be penalized if you lay somebody off soon in April, and then as long as, if you want to get the money, you just got to bring them back before June 30. As much as I thought it was attempting to encourage people to not lay people off, it seems to be doing the opposite effect in the short term. But maybe they're just acknowledging what could be the inevitable for some people. So that's an intense slide. Somebody asked, can you restore the employees June 30th and lay them off in July? It's a valid question. I have a feeling that you're likely going to need to keep them for at least the 8-week period. But in all technicality, probably no. I would say, I don't know off the top of my head, but I'm going to say you probably need to keep them for 8 weeks. And then after the 8 weeks, if you want to get rid of them, you probably can do that without having any further complications with this law. Okay. So that's the Paycheck Protection Program. It's intense. It's like 10 slides that can change your life. So just keep in mind we're gonna go over 2 more programs, and that's why this webinar is so long. This stuff's complicated. If your head is already spinning, my advice to everyone is really you want to get together with your accountant, your financial professional, maybe your business advisor, and your attorney, and you want to workshop this. You don't just want to get a loan, you want to get a plan. So if we're going to be doing X and we're going to be down 50% this year, what is the plan we want? And then which of these options maximizes our ability to really stay in business and then be profitable? And then maybe number 3, keep people employed. Because remember what I said on the last webinar, the business has to be healthy before anybody else has a job to return to. So if you're worried about layoffs, you can't be worried. You have to protect your company first, or if someone laid off, will not have somewhere to return to. Okay, another major advantage, Paycheck Protection Program. Keep in mind, this is different from the disaster relief loan. There's a deferral in repayment of the part that's not forgiven of at least 6 months. It could be up to a year. The law literally said 6 months to a year, which I don't know which one they're going to go with. So I just was on the cautious side and said at least a 6-month deferral. So what does that mean? It's great. It means you don't have to use the money you just borrowed and start paying it back right away. Okay. Somebody had asked about how do you calculate an employee? And that was my question too. And it was actually not easy to find. There's a couple of definitions that I found for equivalent full-time employee, but it wasn't quite clear specifically which one would apply here. There's a general idea that it's based on your norm. So if your norm is 40 hours a week, then a full-time employee would be somebody who works 40 hours a week. And then the idea of a full-time equivalent is you take all the other employees you have that work, let's say they all work 20 hours a week, and you add them together. So let's say you have, let's make it easy. You have 4 employees making 20 hours a week. That's 80 hours. Divide that by your norm, which is 40, and you would have 2 additional full-time people. The Affordable Care Act uses 30 hours instead of 40. So they're going to have to give us some guidance on exactly what definition they're going with for the full-time equivalent. It's likely going to be what the IRS generally uses, but they didn't give a definition for it. So this is what I found so far on the full-time equivalent calculation. So that's something we're going to have to clarify before you can know exactly what you want to borrow. Okay, how to apply. All right, so this is going to be the application process through your bank again. The disaster loan's different, straight through the SBA. This is going to be through the banks. All the banks are going to get in on this because the government's directly paying them back. It's a little bit of free money for the bank. It's guaranteed money. Everybody's going to get it. So at this point, they're just clamoring to see how many 7A loans they can give out. So every bank anywhere is going to be offering the 7A loan program. But yeah, that being said, if you need to find a bank, feel free to reach out to me. We'll find one for you. It's not out yet. Basically, the CARES Act directed that they get out the process by April 11th. And they're, scrambling. This is the federal government here. So I wouldn't expect the smoothest rollout, but at least it's underway. It could happen any day because they're clamoring to get this money into the economy. It could happen tomorrow. I don't think it will. It could happen by Friday. That could be a realistic timetable, but it definitely should be available by April 11th. Now, just because you applied April 11th, it doesn't mean the money would be in your hand that day. It could be very fast, but doesn't mean it would be the 11th. So I wouldn't plan to have this money in hand for 2 weeks. If it's there earlier, great, but that's what I would be realistically expecting for applications. All right, so I'm taking questions via chat just because we have a large audience. So if you do have a question, please feel free to chat me. Otherwise, what I'm going to do is I'm going to go ahead and go to the next thing that we need to consider. So we need to consider these 3 options together. There's no, you can't look at any one of these programs without understanding the other ones because they're exclusive in some ways, meaning if you get one, it's going to prevent you from getting the other. So if you do it blindly, you might accidentally do something you shouldn't have did. Because we're all about maximizing your profits and your success. So let's look at the Employee Retention Tax Credit. This is also new under the CARES Act. So this is nothing that existed before. And it is something where if you're getting the 7A loan, you're not eligible for this tax credit. And if you want the tax credit, then you can't get the 7A loan. So what does that mean? You're going to have to do an analysis of whether this tax credit's better for you than the loan, if you want either of them. So let's talk about the tax credit. Okay, the Employee Retention Tax Credit, who's eligible? It has more limitations. So if you're not fitting these eligibility qualifications, then you're not going to get this one. So that makes the decision easy. So you had to be partially or fully closed. Now, that's a lot of businesses. You have to already have been carrying on trade in 2020. Oh, they want to know, oh, sorry. Before I get into this, somebody asked about the procedure about the loan forgiveness. The loan forgiveness procedure for Payment Protection Program is after the 8 weeks is over, you then apply for forgiveness to your lender. And your lender is basically obligated to forgive you the amount of monies that you spent during the 8-week period on the allowed expenses that we went over. So that's how they are keeping your feet to the fire to make sure you actually didn't just go buy a yacht. If you went and bought a yacht, you're not going to be able to get that forgiven. the procedure is not really out yet, but it's going to be through the same bank that gives you the loan. So it'll just be, you'll get the loan and you'll get documentation that you'll have to turn in following the 8 weeks. So we can talk more about that if you have more questions. Okay, sorry. All right, back to the employee retention tax credit. All right, so you have to have been carrying on trade in 2020. You have to have been fully or partially suspended, and the suspension was from a government authority legally limiting commerce, travel, group meetings due to COVID, which most everyone has been. There's no definition of partially suspended. So if you can sneak in there, you'll probably qualify. Okay, and then there's a second way to qualify. And the second way to qualify is if you were open the whole time. You had a online business, didn't affect your ability to be open, but you're down more than 50% in gross receipts. Then you will also be eligible for this credit. So that is kind of a way to get, so they're clearly trying to get people who were impacted the most to be eligible for this. There's a difference to this if you have over 100 employees. This is a small business oriented webinar, so I just did the part for 100 employees or less. So for this credit, the way the credit is, it's a 50% of eligible wages. So you're going to basically not have to pay 50% of wages that are eligible under this list. So we have to define which wages are eligible. So as long as you have 100 employees or less, any wages paid to an employee while the business was partially or fully shut down. So this is going to be, starting when the original government closures started. And then if you're doing the 50% down, any wages paid to an employee during the period when you were 50% down through when you get back up to 80% down, which is in the previous slide. So that's the wages during that timetable. So remember, these are either or. So also amounts that you paid to maintain a group health plan are included in these eligible wages. And then there's a caveat here that if you paid somebody during an eligible period, so you were closed for 2 months, somebody would have got $15,000. After they got $10,000, they're not, no more of what they are paid is going to be eligible for the credit. So the credit is, the wages are capped at $10,000 per person. So that's the eligible wages. And then remember, the credit is going to be 50% of that. 50%, so let's look at it together. 50% of what you paid to employees while you were shut or partially shut can be credited back to you with limits. Up here we have $10,000 per employee. That's a lot of money. The general idea is if they can give you that much back, if you could potentially keep more people than just having to lay them off. All of these seem to be incentivizing employers to not lay off. So see, I went the wrong way. The way that this money is returned to you is it's a credit against the employment taxes that would have been due that quarter, quite similar to the Family First credit. And so you say, well, what if I'm owed more than I would have even had to pay? Okay, if your credit exceeds what you would have had to pay out in employment taxes, you get the money. The overage is treated as an overpayment and refunded. So they send you a check. All right, so you have to think, whether this method is going to be better for you or if you're going to do better under the 7A loan. There's a couple limitations. If you get a work opportunity credit, you can't count the employee for both of these, an employee for both credits. And same with a paid family medical leave credit. So these are just kind of caveats depending on how you're already counting employees for other tax credits. But other than that, that's the credit. So does anybody have any chat questions about that? I know it's it's intense, but if not, we'll move on to the next opportunity. Okay, let's see. I don't see any questions. So this is the third opportunity. So keep in mind that that credit was different. It's different than the economic injury disaster loan and different than the 7A. So for the economic injury disaster loan, this was already in place. You've seen it through the SBA if you've been to their website. This is a loan that's only available usually after a hurricane, after tornado. That's an injury disaster loan. But they're opening it up for COVID, and by now it covers every state in the country. It used to be certain states, and now every state in the country is an economic injury disaster area for purposes of this loan. So how does this loan interact with the 7A loan eligibility? So if you have already received from COVID an economic injury disaster loan or applied for one and you get it, it doesn't mean you can't apply for the 7A loan, but the 7A loan will be reduced by the amount you've already got out in the economic injury disaster loan. So it's not that you can't get it, but it's like dollar for dollar reduced. So really you can't lose. They're not out to penalize anybody who already got one of these. The economic injury disaster loan terms, like I had discussed earlier, are different. So there's no personal guarantee. There's no personal guarantee on the 7A either. They waived that for both. There's no requirement like there used to be that you couldn't be able to get credit elsewhere is the only way you could qualify. They've waived that. There's no business credit check. Oh wait, there is a business credit check for loans of 200,000 or more. But if you're going for under 200,000, all they're going to do is kind of check that you exist. I think they probably forgot, but they left the idea that collateral might be required if you get a loan over 25,000. We think as a group that was probably an error, and they're probably going to correct that. But currently, you could potentially have to put up collateral. I don't think that's going to end up being the case. Now, the maximum interest rate on this loan is 3.75%. So remember the other was 4, so it's not that far apart, but every little bit helps. And the repayment terms here can be up to 30 years, but it's not really that you get to choose. It's more that the SBA is going to give you a certain offer based on eligibility. So here's the qualification for economic injury disaster loan. Once again, not more than 500 employees. Also, individuals, sole proprietors, independent contractors can also qualify. I'm going to skip down. You have your private nonprofits, small agricultural cooperative. Now, the business has to have been in operation since January 31, 2020 of this year. And note this, the business must have been impacted by COVID-19, and the loans are generally going to correlate with the impact. So what does that mean? Under the economic injury disaster loan, SBA is looking at your numbers. So if you're down 10%, you're not going to be able to get as much as if you're down 99%. So this may not be the loan for you if you're only down 10%. There's no minimum credit score required. I think they're going to be very lenient when it comes to credit scores. Historically, the credit had to be acceptable to the SBA. I mean, at this time, it seems unlikely that they could keep that up because you could have had great credit till last month. And that's why you need the loan. But get out the party hat. This is going to make your decision even more confusing. The disaster relief loan now includes an emergency grant, and this might be music to your ears if you've been waiting on fast money. And it might incentivize you to go for this over the SBA 7, which is going to take longer to get money into your hands. So you can get up to $10,000 if you need it due to issues related to COVID-19. From the way that I read it, you don't just get to say, I want 10,000. You have to be able to justify that you need at least that much. And if you don't need 10,000, but you do need 1,000, then you might be able to get a grant for 1,000. The grant is not required to be repaid. So it's more free money. But keep in mind, if you got one of these grants and you got $10,000 in emergency relief that you don't have to pay back, then you can't go get the 7A and get more forgiveness. You can go get a 7A if there's, money left over that you haven't been able to take advantage of, but the amount that's going to be forgiven is going to be reduced by the 10,000 that you already got basically forgiven through the grant. I would say they're likely contemplating, somebody using this to bridge the gap until you get to the 7A portion. And it's not wrong to apply for this. It's totally fine to apply for the grant. And it's really going to be kind of like on your honor system as far as I can tell. But, they're getting flooded right now. So if you're interested in the emergency money, probably after this call, you want to go apply for it. Because this is the only program that's offering you any kind of money related to that one. All right, so how can you use the emergency grant? You can pay sick leave. You can maintain payroll. You can meet increased costs. You can make rent or mortgage payments. Nice. And you can use it to repay obligations that you can't meet due to a revenue loss. So it's emergency money for people who need something as opposed to closing up. Okay. How do you apply? Just go right here to this sba.gov/disaster. You'll find the application process. It's online. They will specifically ask you about your numbers. So you have to have all your financials ready. They are assessing how far down you are from last year. So the thing about this program is not as concrete as the 7A, where you can calculate best you can what you're going to get, and they're likely going to give you what you calculate. Okay, so let me take a couple questions here. Is there a limitation to the maximum net wealth of the business owner? I'm trying to think. I don't believe so, but I will check back with that question. So there is some information that goes toward max salaries for high paid individuals. I have not seen specifically anything as a caveat related to high net worth, because remember, this is a business loan and they're not making you come out of your pocket to help your own business succeed. But there are restrictions on how much one of the higher paid people can get paid over the course of a year if they're taking one of these loans. And I didn't put that information in here, but I'd be happy to follow up with it. They're high limits. So it's not really based off your personal self-worth. It was based off how much you were getting paid out of your business. So anybody with a high, well, that could go either way. So let me follow up with that information afterward to clarify that one. Okay. Can we put the link to the emergency grant here? Yeah, this is it. The sba.gov/disaster is the link to get to the emergency grant page. sba.gov/disaster. You can also just Google EIDL sba.gov. They're all over it right now. If you're interested in that one. All right, so this is a little comparison chart. So, you know, if you're looking for higher money, you know, the Paycheck Protection Program gives out more. This would be for a bigger business that can show a lot of payroll. The evidence of need for PPP is assumed, where with SBA, you know, or with EIDL, you have to show it. Forgiveness is a specific calculation of payroll for PPP. For EIDL, it's really a $10,000, that's it, you know, grant. Everything else you have to repay. The deferral, as far as I could tell, PPP has minimum 6 months deferral. I did not find a deferral provision for EIDL. As far as I know, it doesn't have deferral. Interest rate, 4% on PPP, 3.75 on EIDL. So keep that in mind. And so really it's not either or, it's just that if you get EIDL, it's going to diminish what you can get under PPP. So it's not really either or for those. This is a little bit more information on other things that are under the CARES Act that might be of interest to you. Somebody asked, do you need to visit the bank's physical location? No. The EIDL loans are online through the SBA. The banks themselves will likely be having all electronic processes to get the 7A. Remember, the 7As aren't out yet. The 7A process isn't done yet. The only old 7A is out, and that's not what you want. So likely your banks, if you Google it, the banks they're like ready to give you out this money. So they're fighting over who can give out the most because it's going to make them money. All right, so let's talk about this SBA subsidy of existing SBA loans. This is a really interesting tidbit that I found within there. So this has to do with loans that were already made, not a new COVID loan, with SBA 7, the 504 program, and microloan program. They're basically saying that they're going to defer payments on this loan for these types of loans for 6 months. But not only that, they're basically going to pay the principal and interest and fees. So it's not just a deferral where you have to pay it later, it's just knocking it down the line. They're actually forgiving current SBA portions of the loans, which is really exciting if you have one of these loans. If you have a question about this subsidy, this is not what I did this presentation for, so I haven't looked deeply into this. If you have a question about this, we can follow up with it. You're going to need to talk directly to your bank that gave you this loan and ask them about how and when this subsidy's being implemented. Likely they're scrambling to get that information together right now, and they will reach out to you. It's not on you to do it. So that's exciting if you already had one of those loans. Not sure who that applies to, but if it applies to you, that's great. Then there's a payroll tax deferral. Okay, the payroll tax deferral is also something you have to consider when you take the 7A, because if you take the 7A with the forgiveness, right, you're getting that 2 months basically of all those expenses forgiven. You're not going to have the opportunity to do the federal employment payroll tax deferral. So if you don't take 7A, what you can do is defer the payroll taxes you would have had to pay federally to December 31, 2021, which means you don't have to pay any of them this year. You only have to pay half of them next year, or by December 31, 2021, and the other half you could defer all the way to December 31, 2022. What is this doing? This is letting the federal government get its tax money, but it's giving you a lot more time to come up with the money to pay it. But keep in mind, if that looked good to you and you got the 7A loan, then you know, you're only getting that and you're not getting the deferral. I'm not quite sure why they made everything mutually exclusive, because they made it very hard to make decisions. I kind of wish they had come up with a comprehensive program, but they instead made it, you know, hard for you to decide what to do. Okay, this is another page of CARES Act highlights that we're not going over in this webinar. It doesn't mean they're not important. It doesn't mean they don't deserve our attention. This is just, I just didn't get to these. So if you're self-employed, there's a deferral of your self-employment taxes from the basically till January 1, 2021. So it's similar to the deferral for you know, the business owners. I'm not quite sure if the 7A knocks you out from that. I'm guessing it probably does. Okay, this is when I talked about with retirement. So this is where you want to talk to your financial planner or provider if you need to get money now. If you say 10 grand's great, 10 grand's not enough. You've got an IRA you could dip into. They're changing minimum distribution rules and penalty rules because they're trying to keep everybody going. So they're not going to stop you from accessing or penalize you from accessing some of this retirement money the way they normally would. This is something you want to talk to your plan provider about. It's going to be something that I'm not an expert on, but I just want to mention that as another source of kind of new way to find money that wasn't there last week. This is another one about the distributions. They're not going to be subject to the taxes. And then there's new plan loan abilities. So you don't want to take the money out, but you want to take a loan out of the plan. The rules around taking these loans, usually they penalize you, or they have very strict restrictions. They're loosening those as ways to get people liquid. So if any of these things regarding your retirement accounts interest you, talk to your financial provider about those. So we have the pension funding holiday for contributions to single employer defined benefit pension plans. So you can talk to your provider about that. And interestingly, if you're doing okay through this and you feel like it, you can pay up to $5,250 a year for basically toward educational assistance, and it will be not considered part of the employee's income. So you could look more into that if you're interested in that. Okay. So far we've made it through the three major changes. I just want to draw your attention. Let me see if I take a question real quick. Can you apply? Okay, somebody asked, can you apply for the emergency grant, or is it only tied to EIDL loan? Yes, the emergency grant is only tied to the EIDL loan. It's basically an advance of the loan because they know you need it in your hands ASAP, but it's considered part of the loan, except they explicitly state they're going to forgive the grant portion. So you can't just get a grant. You're getting a grant, which is really just an advance on this loan that you're getting. However, if you say I need 10 grand and I don't need any more, you know, then perhaps you could, you know, just get the grant part. But they're going to look at how much you're down. So, you know, if 10 grand might be nothing for what you need, or it might be triple what you need. The SBA is going to kind of decide that for you. So keep that in mind when you apply. It's not necessarily just what you ask for, but it looks like they're not allowed to go over 10 grand. It's possible maybe they could if you had some kind of specific situation. So I would just apply and talk to them when it comes to be your turn, and get as much as you can qualify for, I would tell people. Okay, so here's a couple other options that I want to draw your attention to if you're in the New York area. So New York City rolled out their own plan or offering, I guess, and it also includes a grant program. So this is offered by the city of New York. This is only if you can show a 25% decrease in revenue basically during the COVID period. Some of you might be easy to show that. Others, you know, I've heard you're going to see the losses in a couple months, so you can't show it right now. You might be able to be loosey-goosey on showing it, but you're going to have to at least be able to explain and articulate how you're down at least 25%. This is limited to New York City businesses only, so if you're outside the boroughs legally, then this wouldn't apply to you. And it's for smaller people. It's from one to 4 employees only. This is the exciting part. You could get a grant covering up to 40% of payroll for 2 months. So remember, a grant is money you don't have to pay back. So this is another exciting opportunity. I'm not quite sure how fast they would be able to get money into your hands. And the caveat to this is this will likely diminish your SBA 7 or EIDL loan, because in those applications they ask you, have you received money from other sources, you know, regarding COVID, and you would have to say yes if you got a loan under this. So it's not really, they're not mutually exclusive, but they're going to reduce each other. So it's not necessarily like an extra bonus. But here you would get a grant up to 40%. What does that mean? I don't know. So it doesn't necessarily mean you're getting 40% of it. But if the grant's better than, you know, something else where, you know, this might be the way to go. So you really have to play it, you know, however is going to work best for your business, depending on your needs. If that wasn't enough, New York City also has a small business continuity loan fund. Once again, only New York City businesses. This one's for more businesses. It's if you have 100, under 100, still have to show the 25% decrease. They're offering interest-free loans up to $75,000. So keep in mind that what you could get under SBA 7 or EIDL might be reduced. How would that interact with your, you know, forgiveness portion, right? So here, none of this is being offered to be forgiven. But it's at 0%. It's pretty good. So like we said, again, it's not either or, it's what you can get. I'm of the opinion that the NYC loans are going to likely take a long time to process, because they're going to get slammed and they don't have the resources that the feds do. So if it's down to timing, I think EIDL is the quickest one. Somebody asked, is there any early repayment penalty or limits? No, as far as I know, they're not. They're basically happy for you to repay it. So I can triple check on that, but from what I believe, no, there aren't any. There aren't penalties, there aren't fees, and there aren't repayment penalties, because they want you to repay it as fast as you can. Okay, so let me see if that's the end or if I have more. Okay, well, this is the last one. So there's what I wanted you guys all, I encourage everybody to keep looking for more money. There's never enough money. Everybody and their brother is coming out of the woodwork with grants, and, you know, whether they're small or big, it could help somebody that we all know, right? So let us all know if you come across something where it's a new grant, it's a new loan opportunity, because it could be right for somebody that we know, but we can't apply for them if we don't know about them. So I'm trying to keep a comprehensive page, but these opportunities are kind of growing by the day, so it's not going to be able to cover everything that comes out. I encourage you to reach out to the associations that are related to your business type, because that's also where we're seeing loans and loan opportunities come from. The government also gave out some money to like associations and business associations and things to help people apply for these loans. I encourage everybody actually to read the CARES Act, because the CARES Act creates potential opportunities for new business opportunities, depending on what field you're in. It's an 800-page act, so it's hard to absorb all of it. And so I wanted to emphasize that these were the highlights. But if you have any questions, I actually got this in a lot faster than I thought it would. It's impressive. So if you have any specific questions, feel free to chat them. Otherwise, I'm going to be putting this webinar up on my website in the next few days. I'm happy to email you a copy of these slides. Just keep them private. And if you want specific counseling on any of these, you can email me and we can set up an introductory call. So we're taking questions now. If you have any questions, feel free to ask them now. So, you know, we have people asking, you know, what seems better, Paycheck Protection Act or EIDL? To me, if you don't need the money express, as in yesterday, I'm of the opinion that Paycheck Protection Act is, depending on how many employees you have and your need, it may be the best way to go. Keep in mind that if you do get EIDL, it's not going to diminish your ability to get the Paycheck Protection Act. It's just that you're not going to be able to, you know, get extra forgiveness. So it doesn't necessarily have to be an either or with EIDL, but I honestly wouldn't apply for EIDL unless you have a business where you need that, you're way behind, you need the money to operate, you need it to function, you need it now, then that EIDL is made for you. If you're somebody who's just tight, you can make it a couple more weeks. You would prefer to have the extra cash around, but you're going to make it that far, then I would likely encourage you to go for PPP. That also leaves EIDL opportunities to be able to get through faster for people who need it ASAP. So that's kind of my overview of this. So yeah, if anybody has specific questions I didn't go over, you can feel free to email it to me. I may need to even check on it. I'm going to try to check on some of the questions that came up and follow up with everybody that was on the call. But this is an intense amount of information, intense. You're not really required to understand all of it. What I encourage you to do is get together with your advisors and let them help you. Let your accountant help you. Let your attorney help you. Let your financial provider help you. But now's the time to make the plan. So the info's out. So now we make a plan, and then so we know what money to go get when it comes out. Somebody asked whether 1099s can count as employees. Yes. So when it comes to that PPP, the Paycheck Protection Program, they're counting your expenses to your contractors as part of payroll because they're acknowledging that businesses run that way. So go ahead, go back for PPP. For the employee retention grant, the definition, someone's asking about the definition of the employee within that. For the retention grant, it's highly unlikely. So we're getting our terms mixed up. There's an employee retention tax credit. I don't think that will apply to 1099s. That's got to do with people that you pay as W-2s. So I think that's what the person's asking about. So if you had the 1099s, you're likely gonna do best under PPP, unless you need it ASAP. All right, so if you have any other individualized questions, do email me. Look through this.
Tiffany.
Go ahead.
Hi. Quick question. I have clients who own multiple businesses in multiple states, and they own 100% of the business. And one business in East Coast, another business on the West Coast. I don't know if you know this, but if you can just, your thought process, applying for the 7(a) type of loan or the other one, how that will play the individual applying or business applying as same owner, and the same owner applies for 3 different loans? And
Okay.
are there any restrictions on, let's say, high net worth for high net worth individuals?
Okay. Thanks for asking. Okay, I'm gonna put you back on mute. So I was just looking this up, and from what I can tell, they're more focused on the individual business and its payroll and its employees and contractors, because ultimately this money is not necessarily ending up in the hands of any owner. Ultimately, really, it's coming in, it's going right back out to these employees. So from what I can tell, I think each business can apply for their own help and loans, because each business is going to have its own needs. Just because the owners are the same doesn't mean the business doesn't have the needs. So from what I can tell, it is not going to be tied to the owner. It may, when it comes to being able to get forgiveness for paying yourself, that's when they're going to come in to say, okay, well, you're not going to be able to get, 14 salaries forgiven from 14 different businesses. But the businesses themselves will be able to get the loans. That's what I understand, but I'm going to look more into that question and follow up. From the high net worth individual question, from what I've found, there's no penalty. A high net worth individuals can still apply. The only restrictions that I've found have to do with how much a employee can be paid. We're talking about like millions. There's payment restrictions if you take 7A. So you're not going to take 7A and then pay, your highest paid employee, millions and millions of dollars, because then you would have had the money to make it, they're saying. So if the highest paid people are willing to say, okay, I'm going to take a reduced salary down to like 400,000 or something, then they're allowing the business to get 7A. But I didn't add that in the slideshow, and there's a lot of specifics on that from the law. So let me follow up in the with this question, and I'll email everybody a little bit more about those, because those are really good questions. And then, so we have this question again with partners who are not on payroll but get guaranteed payments in K1 count toward the payroll calculation. Yes, they will. So as long as your income is derived from the business, that's going to be included in the payroll calculation. It doesn't have to be specifically W-2'd people, and they went out of their way to make sure that was included in there. Yeah, and then we had somebody reach out to say that that the SBA could consider multiple businesses in the way that they do, where they could potentially look at multiple businesses as a single entity. And if they do that, it's not necessarily a negative, because if you combine multiple businesses as one entity and look at them that way, you're going to have a whole lot more employees. So you're going to be able, the amount to borrow is going to go up. So it is, I will look more specifically into that question, because those are very technical questions that we should get the answers to. Somebody asked if you get a W-2 and a K-1, does the K-1 income count? That's a very good question. I'll have to check on that question. Meaning, this means your bulk of your salary is likely paid through the W-2 process, and the K-1 is the money that you make off of running the business as your profits. I believe what's going to happen is they'll combine, and it'll be $100,000 cap. So remember, there's $100,000 cap on what one employee can be counted towards. So if you're combining W-2s and K-1s, you're probably going to hit 100. And if that's the case, I'm going to assume that you likely can count them both up to 100, but I'll check on that question. Yeah, so I'll check on the more specific questions individually, And like I said, you might have more questions after you digest all this. And I still have questions. Everybody's waiting on guidance. But feel free to email me your questions, and as a group, we'll try to get a handle on all of this. So I hope everybody got something out of this. Like I said, get your money out, do your calculations now, so that when the loans are ready, you're ready, because everybody and their brother is going to apply on the same day for these loans. Okay. Thanks so much for listening, and I'm gonna end the gonna end it now, but thank you for your time.